Good evening, we are Tuesday, 11th of December 2018. Here's a quick market update on the current yield curve in the US and other major G7 countries. Fears that the upswing in global activity since the financial crisis 10 years ago may be coming to an end are starting to show up in a key financial indicator, the so-called yield curve, which compares the yield on different maturities of government bonds. It is now close to a key level that in the past has been a clear indicator of a looming slowdown. Normally, the yields on longer dated bonds are higher than those on shorter dated ones, because investors demand more reward for tying their money up for a longer period. This is because of higher risk that inflation may erode the value of their money over time, or that companies or governments will default on their obligation before they are due to be repaid. When investors worry that the outlook is deteriorating, that normal state of affairs can be reversed, and bonds maturing several years away can yield less than those maturing in the near future. In the jargon, this is known as an inverted yield curve. And in the past, this has tended to precede the arrival of recession. What is worrying traders today is the fact that the yields on 10-year bonds and those on 2-year bonds are almost the same. The yield curve, in other words, has flattened, if not yet inverted. Investors are watching nervously to see if it will invert in the weeks and months ahead. One of the key determinants of the yield curve is what happens to interest rates, because these have a bigger influence on short-term bond yields than they do on longer ones. So if the Federal Reserve continues with its current pace of rates hike, then the yield curve will almost certainly invert. So all eyes are looking out for evidences that Fed Governor Jay Powell is easing back on the Fed's tightening path. Last week's non-farm payrolls were slightly disappointing, with only 155,000 new jobs created, lower than the recent average. This suggests that there may be less pressure on the Fed to raise rates, although most traders still expect at least one more rate hikes next week, even if we are getting into the end of the calendar year now. Well, that's all on this short topic. Speak to you soon. Goodbye.